All right, welcome Passive Pockets community and all the rest of you joining us today. We're just going to give it 1 minute and then we're going to jump right into it. So bear with us here for the next 60 seconds. All right, we are ready to rock. Welcome Passive Pockets community. Welcome everyone that's joining us today and welcome Jay Parsons, Eric Sussman, and Greg Willett. Gentlemen, we appreciate you being here. We are going to jump into discussion today. We're going to be talking about the multifamily sector and the broader economy today. I'm your moderator, Paul Shannon, co-host of the Passive Pockets podcast. Before we get into the rules of engagement, let's get you guys introduced so our audience knows a bit about your backgrounds and your credentials. Jay Parsons, why don't you start?
Sure. Again, my name's Jay, and I started in this industry 16 years ago under the tutelage of the guy on the right side of my screen here, Mr. Greg Willett, and been stuck in the rental housing research since then, and of course, fallen in love with it. But Paul, thanks for having me today.
Great to have you, Jay. Greg?
Hi, everybody. Again, Greg Willett. I am with a company called LeaseLock, and we look at risk mitigation in the multi-housing space and rental housing overall. I've been in the industry for 30 plus years, really at that intersection of technology and housing. And I do take either the credit or the blame for Jay Parsons.
We'll cut you some slack on that one. Eric, how about you?
I'm the free agent, I guess. Anyways, hi everybody. Eric Sussman. I'm a faculty member at UCLA's Anderson School of Management. I've taught real estate and everything real estate related for 30 plus years, really to graduate students. And then outside of campus, I'm the managing partner of Clear Capital. We're a multifamily value add sponsor.
All right, it's great to have all three of you guys here. We're going to cover a lot of ground over the course of this hour. The big three pillars of the conversation are going to center around interest rate policy and its relation to capital markets. We're going to talk about supply and demand dynamics. We're going to talk about the current Trump administration's policy overhaul. And really, the goal of the discussion is to help our community of passive investors understand how all these factors are impacting their current LP positions and what they should look for as they consider allocating into future multifamily acquisitions. Time dependent, we've also got some big picture stuff to talk about, more long-term trends. We may get to it, we may not. Things like privatizing Freddie and Fannie, solving the affordable housing issues, big stuff here that may take more than just a few minutes to touch on. Alternative investments in 401ks, et cetera. So there's not just LPs on this call. We have a lot of GPs too. We've got some brokers. There's some other industry professionals. So I'm anticipating the insights shared will benefit you all as well in your strategic approach, even if you're not a passive investor. Okay, so this is going to be really a macroeconomics focused discussion and how the dynamics of complicated issues intertwine and impact the multifamily sector. I'm going to ask you guys very direct questions to individuals, respectively. I'm not going to ask the same question to everybody, but if you have interjections, additional perspectives you want to add, if you want to disagree and throw a jab, you can do that too. I'm really here just to provide the guardrails of the conversation and reel us in if we get off track. So let's dive right into it. We're going to touch on interest rates and capital markets first. Jay, first question is going to you. Expectations are that there's going to be a rate cut next month. Actually, the Jackson Hole meeting happened today, and it sounds like Powell took a little bit of a dovish stance for the first time in a while. We're probably going to see a new Fed chair in May in 2026 that Trump will put in office or put in that position. You figure they're going to have a pro-Trump monetary policy. And he's putting a lot of pressure on Powell to lower rates today already. So we kind of know what might be coming. There's no guarantees. but how should passive investors craft an allocation strategy around moves in the federal funds rate? Is that a smart thing to do? Should they be waiting and seeing what happens, or always be investing, quote unquote?
Yeah, well, Paul, thanks for starting me off with a softball question there.
You bet.
No, it's obviously a tough topic, and I'll tell you, it's a humbling one because I think every economist in America has gotten this question wrong in terms of the depth and the number of rate cuts over these last few years, and certainly we've not seen as many as we would have thought. I think your logic is right, but I'd remind everybody that if you went back to a year ago, I think it was last September. We had just seen a rate cut. There was expectations for more. There was a lot more bullishness in the industry. If you went to industry conferences and events, you listened to these webinars like this one, heard, guys spewing hot air like me. Everyone was saying that, hey, it's gonna be a better year for acquisitions in 2025. The gates are opening, lower cost of debt. And obviously that didn't materialize as we all expected. And so I would say that, I personally believe, and I'm encouraged by what Chairman Powell shared today. I think we do need to see some rate cuts. I think that would benefit a lot of parts of the economy. I think inflation's actually been in the Fed's target range these past two years. When you take out the lagged housing shelter rent data, you actually are at 2% inflation for the last 2 years. So I think there's a reason for it, but I would just say, to answer your question, Paul, I think it's hard to build an investment strategy around it because, number one, I think the cap rates today are probably already reflecting rate cuts that are to come. And then number two, it's tough to, even the Fed can't, with its own dot plot survey, doesn't accurately forecast its own future decisions. And so I think you want to look for other signals in the market beyond just trying to pinpoint where the federal funds rate might be.
Good advice. I think sometimes people put too much weight on what's happening with the
Yes.
Federal Reserve and how it's going to impact their investments, and their strategies built around something that's not necessarily concrete, or doesn't have as much carryover as they may think. And to stick with that, Eric, if the federal funds rate does fall, do you expect borrowing rates in the 10-year Treasury to fall as well? How would a drop in the FFR actually affect capital markets?
Right. And there's been a lot of confusion about that. I mean, there are different forces, obviously, that impact the Fed funds, the short-term rates and longer-term rates. Look, the Fed fund rates, it really affects, you're talking floating rate debt, right? And so, whereas the longer-term treasuries are based on far different factors and influence, of course, are fixed rates. There's a high correlation. So if you look statistically over time, there's a strong correlation between the short term variable rates and again the treasuries, but again different forces. Just keep in mind that as far as the Federal Reserve goes, its only control over treasuries is through monetary policy, right? Quantitative easing and tightening. Are they going to be buying back? And of course, since the financial crisis, they've been trying to shrink that bloated balance sheet of theirs. But that's a big question mark as to how that works out. And frankly, then you get into all the geopolitical issues, of course, because of course we rely so heavily on foreigners, of course, to purchase our treasury debt. And I don't think we're making a lot of friends globally necessarily. So it seems like not exactly perhaps an optimal policy to upset sort of some of our friends and allies and big purchases of our treasuries. But we'll see. My sense is, having said that, look, the 10-year today, because of the comments you made, Paul, about Powell's speech today, I think was down, the 10-year's down, I think seven bips or something like that. So look, the high correlation, but we'll have to wait and see. I'm with Jay on the point that we need lower rates, but at the same time, I'll just make one other comment: is it's kind of tricky when you have the equity markets at all-time highs. And while Jay is right about some of those inflation numbers with tariffs and all the uncertainty and what's coming down the pike with the PPI you may have seen was quite elevated last month. We're in an era of tremendous uncertainty. So I kind of echo Jay's sentiment. It's hard to craft an allocation strategy in such uncertainty.
We probably should have put uncertainty in the title of this webinar. I think that's really the overarching theme, and trying to cut through the clutter to find out what's actually real and how we can make actionable decisions. Eric, you mentioned floating rate debt tied to the FFR, the 2-year Treasury, et cetera, shorter end of the curve. Greg, if the FFR does drop, which presumably it might, do you see bridge financing making a comeback when it does? Many passive investors were burned over the last couple of years, as you guys know, with this type of debt. So if it does make a comeback and that's how acquisitions are happening, what should passive investors be considering as they consider allocating into deals that are using bridge debt?
Yeah, Paul, I'll be sure and include uncertainty in all my answers as we go through the discussion. I mean, looking at bridge financing specifically, I would think that it begins to reemerge, but it doesn't necessarily come roaring back right away. And a couple of things that you have to look at is just how much do interest rates come down. And I think we probably are all on the same page that they come down a little, but not necessarily a lot. And then I would be thinking about with using bridge financing, have we truly stabilized on asset values? And I think we feel like we have for segments of the market and more focused on the top tier luxury product, and still some questions about middle market to value add properties. And the recovery on the pricing will vary from market to market. So I think there are places where bridge financing will make sense, but it's not uniform.
Well said. Yeah, we're going to talk about the recovery and how it's impacting different property classes across the country. And I think we need to talk about supply and demand if we're going to get to that. Jay, 2024 saw the highest number of unit deliveries since the 1970s, which left obviously a lot of markets very oversupplied. But yet, on the contrary, absorption has been historically strong. New move-in lease rates are down, but tenant retention is solid and renewal lease rates are higher year over year. And I've seen mixed data. We're going to talk about data and reliability as well as to whether rent growth is negative or positive market by market. But in either case, wage growth is outpacing rent growth and has been for the last 2 years or so. So, what's the issues that are impacting rent growth and it accelerating and picking back up again? Is it a supply issue? Do we have a demand issue? Is there an affordability issue today or on the horizon? What are you seeing out there?
Yeah, I think there's a lot of mixed signals in the market right now, and I think that does create a lot of confusion. And I look at it as, there's a lot of short-term uncertainty, but a lot of long-term bullishness. The short-term uncertainty is really driven around supply and just sort of the broad economic uncertainty. I think the positive short-term and long-term tailwinds are around the demand story. And this is something like everybody in America likes to look at through like rental trends through the lens of homeownership because we're, despite the headlines to the contrary, like we are still a homeownership nation. Two-thirds almost of American households are homeowners. Yes, homeownership's down, but the rental market doesn't operate merely as a byproduct of what happens in the homeownership market. Rental demand has been strong this entire cycle. Rent growth was strongest when home sales were flying. And I think what you look at these last few years, when supply hit in heavy numbers, rent growth came down. It's still low, even with no one leaving to buy a house for the most part. But the demand numbers have been really good, and the affordability story has been really good. The affordability has gone from, I think, a headwind to a tailwind, at least for the market rate professionally managed rental housing market, both SFR and also for apartments. And I think there's one last thing one point I'll make here, Paul, is I think one of the big issues that we've got to do better at as a country is we tend to think of rental housing as one big brush, like renters are struggling. The truth is it's a very bifurcated market. We do have a severe shortage of affordable housing, people who can't afford market rate, and most of them couldn't afford it even prior to the inflationary run-up and to COVID and whatnot. But at the same time, we have more than 1 million new market rate apartment renters over the last 5 years who on average spend 22% of their income on rent. And so there's ample demand for today's market rate rentals at today's prices. At the same time, there's a severe shortage for people who are struggling to get by. And I think from a policy perspective, as well from an investment perspective, we need to do a better job of understanding that both things are true. They're not contradictory.
Interesting. So let's dig into that bifurcation a little bit and let's shift to you, Eric. What do you see across property classes? We've got A class, we're talking about newer construction, higher end, the higher end of the wealth spectrum as far as the renter is concerned. B is somewhere in the middle, and C is more affordable housing, workforce housing, etc. What are you seeing from an occupancy standpoint and rent growth bifurcated between those property classes? And if you're a passive investor, I want to tie most of this stuff back into that theme. What property classes are you looking to invest in given the uncertainty in the market today?
Well, again, our firm is a value add player, so we've always been looking at B and C product, but that has been a hell of a tough space the last couple of years. I mean, just brutal, frankly. And I put it more gently, but that's sort of accurate. I'm not sure it's finishing, Paul. I'd characterize sort of A, B, and C. It's really, I was thinking of Charles Dickens, a Tale of Two Cities. I mean, do you think that the last was in July, the top two markets were San Francisco and Chicago? I mean, so
Mhm.
you think about where rents have been growing. The strongest markets were the Bay Area and the sort of the Midwest last month. And again, does that mean you should put all your money in Chicago or the Midwest because there hasn't been that sort of supply that Jay alluded to in the Midwest or say certain parts of the Northeast? But again, it's just hard to come up with a necessarily investing strategy there necessarily that you're going to make boku bucks if you start buying value add product in Chicago. Again, I'm not sure that's true. Look, it's sort of again a continuation. Also, speaking of geography in the A and B and C, it's sort of look at the markets that have had so much supply. We're talking, of course, the Sun Belt and Austin and Phoenix, of course, the markets that have had such supply. And not surprisingly, let's say Austin and Phoenix are still really struggling, just dealing with the new builds and concessions and the whatnot. And that's affecting, of course, across all A, B, and C product. So that's how I would think about it, Paul. It's really geography. Where do you think folks are going? And obviously, Orange County remains very strong here in California, despite the rhetoric about California's falling into the ocean or something, and San Jose and San Francisco. New York City remains strong, but again, it's just not tricky to try to make money in those markets. So we'll see. But I think the supply overhang is lessening. I think there are a lot of tailwinds. I'll just make one other really quick interjection: is the immigration thing. The population of the United States is expected to decline this year for the first time since World War II. And, if you think about whatever y'all think about the immigration policy, it's for another discussion perhaps, but let's face it, all the folks they're deporting were likely renters. I mean, every single one of them. It's not even a question. And to think that will not have an impact on the rental market, on demand, because of broad demographic changes, both childbirth rates, marriage rates, and immigration. I think we need to think about that as well across the entire country.
And how that impacts labor as well in certain markets, in Texas, for example, maybe California, down in the Sun Belt. Those are certainly trends worth watching. And I think what you alluded to, Eric, was getting ahead of demand, which I stole from Greg Willett, who said it when I interviewed him on our podcast. Greg, many of these markets that we're going to talk about over the last 4 or 5 years are in the Sun Belt. That's where a lot of the overbuilding has happened, where some of the assets that were acquired are struggling. Um, other markets in the Midwest and some coastal markets, as Greg or as Eric had alluded to, are holding up pretty well. What are you seeing, and what data points can help us predict which markets are ripe to overperform over the next 3 to 5 years if you've got money to allocate today?
I, Number one, I will say that I agree with everything that Eric just said, and he did a good job of. I tend to think of markets in overall performance in three buckets right now, and the first bucket are places where you've got healthy rent growth and it's sort of business as usual, and you start with the Bay Area and New York and Boston, and then parts of the Midwest, headlined by Chicago, and then kind of a middle of the pack bucket where you're getting some rent growth, but it's still somewhat muted, and that would be the rest of the Midwest and various markets across the country where you don't have much construction activity occurring. And then you have that third bucket of places where you're struggling to digest all the new product that's coming online, and you tend to have rent cuts, and most of them pretty minor rent cuts, but more severe in Austin, Phoenix, Denver, are some of the key examples. And as you look ahead, I am going to agree that, boy, pay attention to these immigration numbers. and what we're doing on population overall and the workforce as we're moving there and doing some downsizing. And then one thing, a metric I want to point out, pay attention to as we move ahead are the starts numbers. And I think most people in the industry realize that starts have come down drastically from where we were, and that's what they're focusing on. But I would say pay attention to what we're slowing the starts to, because there are places where we've completely stopped building, but there are a lot of places where we're really returning to what was the historically normal level. And so those areas are still going to be delivering a meaningful block of new product, and we'll still have competitive leasing environments in that top end of the product spectrum.
Now, you guys are data driven well beyond me. I like to analyze the data and try to predict where population movement is going. And in a market like you just alluded to, Greg, where there's a situation where they stop building, so to speak, if population is even growing to a minute level, that gives pricing power to landlords, and that comes in the form of rent growth, which obviously impacts the bottom line in a positive way from an investment standpoint. It puts strain potentially on the tenants, so there's that to consider as well. But it all goes back to the data and trying to find sources that are accurate to make these types of decisions. And we've just seen that the Bureau of Labor Statistics head was fired by the Trump administration for just simply reporting the data. I saw recently this week in Globe Street that US Census just reported that multifamily starts soared to quote unquote the second highest number in any July in almost 40 years, which if you talk to anybody in the industry, I'm not hearing anything like that. I'm hearing that supply is falling off a cliff. And we're going back into an upswing in the demand outpacing supply here in 26 or 27. So, Jay, where do we go as passive investors to find dependable, accurate data that we can rely on?
Yeah, that's a good question. And obviously I think one just a little bit of perspective, and we can talk about the different data points you mentioned from the BLS and the census at length. I won't bore people with that. Greg and I had a discussion on this over LinkedIn as well, and just had a podcast that covers some of this topic. But I think to answer your question on the data, I think one thing is, remember, we're just kind of taking a step back from all the stuff, is that the industry professionals, in terms of like the full-time people like us, Greg and I, and I'm sure Eric would say the same, is and across the industry, people we've never really relied on government data for what's happening in construction, in rents, occupancy. It's like if you look at like census data on rental vacancy, it's also not going to match. It's never matched what you would see from a CoStar, RealPage, Yardi, et cetera. And so I would say that I would just kind of take a step back from the current noise and say, look, if you just need kind of just kind of curious for broad general trends that might be directionally accurate, then yeah, you can use the public data. But if you really need to keep a better pulse and you want to have a more, even as a passive investor, a more active understanding of what's going on in the market and kind of help you determine where you want to be an investor, you really need to have subscription to one of these data sources. And I think there's, a few that are viable. If you are using public data, I would rely more on something like Apartment List, which posts free rent data and kind of extrapolates occupancy assumptions. I think you get, good, certainly better stuff there than you'd get from the census or the BLS on rent and trends at least. Or talk to your broker buddies, try to get them to share some reports with you. There's some, a lot of the brokers post free reports on their websites, and those are also much better than what the census provides. So I would I would take the census and BLS data with a grain of salt, but also just remind folks that that's not a new issue. These challenges have been around a while.
Interesting. Well said. Let's shift gears a little bit. I want to head back to you, Eric. We talked a little bit about wage growth and how that, it's outpaced rent growth, and that's been, a bellwether, I suppose, and some bad news. That's been some good news. But on the other end of the spectrum, consumer sentiment, the University of Michigan Consumer Sentiment Index is down. That's sort of a subjective measurement of where, we as a society feel like our economy is headed, and do we feel confident that we are more in a spend on type scenario versus a tightening up. We're not going out to restaurants as much anymore, et cetera, et cetera. So there's kind of some cracks here showing. There's some cracks showing in the employment sector. So even if we do, let's say in 2026, 27, get a leveling of supply and demand remains, where it's at today, given these sort of stagflationary talks and where we're headed from a jobs market, do you have concerns?
You don't ask short questions or simple questions, Paul, do you? Jay mentioned that earlier. I'm the professor here. I'm supposed to ask the tough questions. It's like a final exam question. And besides, throwing out a University of Michigan data point, Big Blue to a UCLA person is very insulting. But I'll put
Oh,
that
I'm
aside
sorry for that. I should have used
for
Ohio
for
State.
I'll put that aside for a second. Look, and again, I think you're hearing from all of us that we agree with each other, because I think we all are knee deep in this stuff, and it's sort of absolutely true. And what I would say, is you think about, you mentioned consumer sentiment, you mentioned wage growth, and there's job numbers from BLS. Look, there's just no lack of data, of course, and with social media, whether you follow all of us on LinkedIn or wherever, Twitter or TikTok, I mean, the data actually gets disseminated from all types of sources. Even garbage data gets, it's fascinating to me. What I would say is, look, there are just so many moving parts. Just going back to the data and on the wage and labor issue, because to me that is crucial. Look, we're a consumer-driven economy, full stop. The United States is a spending economy. So how the consumer goes is how almost everything else goes. And we have a bifurcated market with the haves, and someone said it's not the have-nots now, it's the have-yachts, which I love that expression, which is very clever. But it's sort of true. So you sort of look at all those data points. I can tell you what I do, and thinking about labor is look, and consumer spending is use your eyes and ears, for God's sake. When you're in airports, you're at restaurants, I don't know, you're getting your aromatherapy, deep tissue, I don't care. See what's happening at those places. They seem bustling. Are they active? And there's no question there is a slowdown. In my case, of course, as a faculty member, I get to see what's happening with these, with graduates and the graduate hiring. And we are in a terrible bear market when it comes to young people and employment right now. And I think that's, to me, both a tailwind and a headwind when it comes to multifamily. It's obviously a headwind as much as when the labor markets are struggling or there's job challenges, it's going to affect the rental market and housing, of course, broadly. On the other hand, there are more 20 to 35-year-olds living back with their parents than ever before. I think it's hard to get the data, but it's say 2 to 3.5 million. It's a pretty wide range. In theory, that's a tailwind, because if and when things get better, I hope my middle daughter moves out of the house. Let's put it that way, okay? I love her dearly, but her return to the empty nest was mixed emotions. So, but she's not alone. There are so many like that. So, anyways, going back to the wages, I'll just make one other quick comment. Is there's no question, Paul, and I think Jay may mention it well. In the last 2 years, wage growth has been stronger than inflation, but over 30 years, it's not the case. So I think we're still sort of dealing with some of the hangover from longer term trends, where again there's that haves and have nots. So we'll have to keep an eye on all of that. But those are some initial thoughts, anyhow.
Makes sense. And it's been said many times by people much smarter than me that you lose a lot of money trying to prepare for a recession than you actually do in the recession itself. But it's fun to predict, right? So, Greg, do you see a recession on the horizon? And if you were, trying to craft an allocation strategy, how would you play defense in a scenario like that versus just hiding your money under the mattress, so to speak?
Bottom line, our near-term forecast calls for meaningfully slowed growth, but not actual backtracking. I think that means we avoid recession by the skin of our teeth is the basic outlook there. Something I would really pay attention to, and Eric alluded to it, is just overall consumer health, and a couple of other metrics that I'm paying close attention to that haven't been mentioned so far is what's happening with credit card debt and delinquency, and the debt volume is running up very rapidly by a whole lot, and we're starting to see some delinquency upturn as well. And then the next step is you get some struggles with auto loans, and that's beginning to happen a little bit. So I think we've already pushed over that first domino that suggests there is some financial stress that's headed our way. In terms of strategies then and defense, what I would really say is pay attention to what's happening on property operations. And is your operator doing a good job on resident retention and getting a little bit of rent growth out of the people who are staying in place? And what's the quality of the residents who are the new move-ins? Are they going to be able to afford a little bit of a rent bump whenever it comes to renewal time? So when the market struggles, operations become more and more and more important.
And operations lead
Can I
back
interject one
to,
thing, Paul? I know first
yeah,
interjection, but really
go,
quick, because
Eric.
Greg made a great point on the consumer and the loan data. I would just add too, Greg, I don't know if you follow, I just saw some data on applications for credit cards across all of the big issuers, and they all said even their application. So think about a leading indicator on consumer spending, and that those are way down as well. So I wonder, I don't know if you've looked at that data as well, or you're tracking it, not just the delinquencies, but also applications, I think is a leading indicator.
Yeah, I think there's a lot of things that are really interesting in debt and credit card information. And I'll also caution folks as they're digesting that data. A lot of times you see information on debt per credit card, but think about most households, you've got more than one credit card in that household. So the amount of debt can be bigger than you think. And obviously, those credit card interest rates are so high that can really chew up a lot of your budget.
Yeah, and one of the things is, again, I'll interject, is student loan repayments, right? Those were stalled under Biden. And again, whatever you think politically, it doesn't matter. I know that's a contentious issue, but the fact is, under the Trump administration, those have started up again, and that's also going to take a big bite out of the spending of those folks. And I assume, again, folks like Greg probably look at that all the time as well.
Well, I want to stay on this topic, and I want to get your thoughts, Jay, on the potential for a recession. And even if we do kind of clear up the supply issue, if we get that recession, how does that show up from a rent growth standpoint? And is that impacting your allocation strategy if you had capital to deploy today?
Yeah, I mean, the recessions are tough to predict, but we do know they happen, and so you got to be prepared for that. And I don't know if it'll happen, later this year or next year, or won't be in the next 5 years. I don't know, but I think as my colleagues here have noted, there's some things we should be watching. Now, in terms of how it impacts strategy, I think it goes back to something Eric said, where there's the haves and have-nots, or the have-yachts, and I like that as well. The I go back to affordability. I know when you look at the challenges today, they're very concentrated at the lower end of the market. And Eric sort of alluded to some of the challenges in the value add space. If you have heavy exposure to Class C, where that's the segment of the market, it's a lower rent, but people spend a larger share of their income toward rent. And so when there's a job loss, or there's income compression of any sort, it's gonna hit that segment more. They're more likely to double up with friends. They're more likely to struggle. We see delinquencies tend to be higher in that part of the market. And so I think you got to be careful, particularly watchful there. I'm not saying you can't invest there, but I think it's really being smart about, if you're trying to insulate yourself, and you're looking at older properties, really understanding the rent roll, understanding the rent income ratios at a property, knowing what kind of value add work you might want to do, and the ability of the current tenant base to pay the rent that you need to justify that. Because turning over a rent roll it can be easier said than done, I think, as everybody knows, unless you're in just the absolute right spot. And so I think it's just, really kind of drilling down to the micro level and working with your investment partners to really understand, who lives in this community, if you're in a place like DC, there's now a lot of focus on what exposure they have to federal government jobs, and you can do, similar things in different parts of the country as well. Just really understanding, you know, again, I would get down to like, who are the people living here, and what everybody now has data on, the average incomes of your tenant base versus the rents, the leases that are being signed. I would just be mindful of those things. And I would also say, though, is if you're investing at more newer vintage stuff with higher rents, your renters also have much higher incomes. And not that they're not going to be impacted by those challenges, but it's typically what we've seen in past cycles going to be less. And it also creates an environment. You're still going to see rent cuts in a recession, but you're going to see people we've seen in past downturns, and including the supply-driven downturn currently, as a flight to quality where demand shifts off market for those who are still gainfully employed. And so I think they're a little more insulated in that part of the market, but not even though never fully insulated. Now, with all that being said, I'll say one last comment, which is, as tough as any recession is going to be, the beautiful thing about rental housing is that, especially apartments, is that even a poor performing apartment portfolio can be 90% occupied. So you compare that to investing in office or retail, where you can be at zero tomorrow with one with one company moving out. So I think in the grand scheme of things, apartments are relatively well insulated, particularly because there's always going to be demand for housing, supplies coming down. But certainly, any individual investment, you still just want to be careful. And I'm not telling you, it's not rocket science, but hopefully that's semi helpful.
Oh, it's very helpful. And I would agree that multifamily is somewhat insulated versus other assets within the real estate sector. And I think it goes back to something that Greg alluded to, that operations are so important. We've seen a lot of, or I'll call them operators, but we've seen a lot of sponsors who are very acquisition minded, very acquisition focused, and not getting into the weeds of how do we make this apartment run more cost efficiently? How do we capture more retention? How do we make this a better living experience for our residents? Those are bigger issues. So we talk about it a lot in the PassivePockets community. Know who your sponsor is, trust them. Can they execute the business plan that they've laid out first? Then get into the weeds on the pro forma and whether the actual deal is good itself. The operator matters much, much more. So, Greg, I want to go back to you. Let's shift gears a little bit. Let's talk about policy. This is going to be one of those fastballs that I just threw at Eric a little bit ago. So we've got uncertainty around tariffs, a lot of flip-flopping. We just had the big beautiful bill passed, which is sort of contradictory to the Doge, budget cut, that we've seen, or the idea around cutting budgets, where the big beautiful bill is really going to be running at a higher budget deficit than we are today. Another 3 trillion added to the deficit. We've got immigration policy that's shifting, as we've seen. And Eric alluded to who's going to buy our bonds, right? So there's a lot of factors on a macroeconomic level, on a policy level, that are potentially affecting multifamily. How do you see those issues? Maybe pick one, pick them as a whole. Uncertainty again around new supply. How does that impact development and projects that are coming out of the ground or plan to come out of the ground in the next few years? And how does it impact value add? What should passive investors be looking for in pro formas to protect the downside?
That's a lot. That's a lot of
Boom.
questions there. But I will say
He
that
does it every time.
Fastball.
yeah, it is. I will say that
Take a swing.
I can model various outcomes when it comes to tariffs or tax policy. To me, the real wild card is immigration. I don't know how to deal with that in terms of setting expectations as we move ahead, because this is just so unprecedented relative to the position that we've been in before. So for folks who are thinking about strategy, I'm going to throw one other element in here that I think is super important, and that is regulation and how much it varies on the state and local level. So understand that component as you're looking at individual deals, and again, the differences in the rules in terms of rent control or algorithmic pricing or fee structures or background screening can make a huge difference in the outcome for these individual deals and what you should expect moving ahead. And it's interesting as we look at the lineup here, you know, Eric, you're in the most regulated market in the country, and Jay and I are probably in the least regulated market.
Thank you, Greg. I appreciate that.
That was by design here to get some sparks flying. But
Yeah.
you know, with these issues, we think inflation may be kind of subsiding, and then we get, you know, alternative data that suggests otherwise. Tariffs potentially could add to that conversation. TREP data just came out year over year, and expense growth, although operators tend to write it at, you know, like let's say 2% on average, expense growth has been much more. Insurance alone was a 12% increase year over year. Professional fees almost 6%, payroll 2.29%, utilities are up 3.65%. Eric, is this just the beginning based on the aforementioned policy concerns?
Right. You throw data like that, and I find myself needing some antacid. I tell you, you know, look, there's no question, as I've said, you know, over and over again, you know, you look at sort of the operations of any apartment house. And a couple of real quick thoughts. One is, look, in a bull market, the rising tide lifts all the boats, and management oversight is pretty easy, right? Just build it and they will come. It's the field of dreams. In a bear market, it's that hyper focus on costs, expenses, and heads and beds, right? It just becomes a very different operational focus. Now, obviously, it's been a real problem because you've got this kind of double whammy we've had over the last, let's say, 36 months plus or minus, which is, you know, sort of anemic rental growth. I mean, certainly less than what was expected on the recovery. You know, it's just, I think Jay said it at the very beginning, is sort of, we all kind of expected more robust rental growth. So you haven't had that. Meantime, the expenses have ballooned across all the categories you mentioned. So you're getting it from both directions. And the question is really what happens from here. I sense, you know, we're going to continue to have sort of inflationary pressures, whether it's tariffs or, again, look, again, and Greg said you don't have to be a rocket scientist. I mean, supply and demand, right? So even think about repairs and maintenance. Who are the biggest, you know, component in the workforce of our repairs and maintenance folks or our on-site staff? It's a lot of the immigrant community. And, you know, let's not kid ourselves that that's not going to have an impact on pricing and costs, as, you know, that just becomes a you know, just tighter supply. So, you know, I think there are a couple thoughts. One is, again, as my colleagues have said, it's going to take really hyper focus on existing assets, on costs and expenses, acquisitions, really scrubbing them and making sure you know, the sponsor or yourselves are really looking at those expenses. And you're right, Paul, not just putting 2% Control D, Control R in Excel, right? You know, giving more thought to the individual components of your expenses and so forth. But because my sense is we're not going to have a lot of abatement there. You're going to continue to see some pressures in those operating costs.
Yeah, well said, Eric. I think I say this often that you can make a spreadsheet, tell any narrative that you like, but reality is when the rubber meets the road and you actually get to operations. And what I've seen a lot of lately are underwriting files that show modest to flat rent growth in year one. And then as supply trickles off, they show rent growth that is above the historical norm. And that's what makes the pro forma work. And then usually they're putting in 2.5 to 3% as far as a generic expense growth number to, you know, because if they put 2% like was normal maybe like 5 years ago, they're not going to get many good reactions from that. They can't do it with a straight face. So 3% has become the more norm now. But Jay, you know, if you're a passive investor looking at an underwriting file, I know it's sort of a generic here. We can't get market by market specific or asset specific, but how do you be conservative as a passive investor when you're looking at that file? What should you be inputting as far as rent growth and expense growth?
Yeah, I think I'll take the latter part first. On the expense side, I think expense budgeting or forecasting has gotten probably easier than it's been since COVID hit. Not to say it's ever easy, but I think it's easier than it's been in the last 6 years. I think we're seeing the key cost drivers, property taxes, insurance, become much more predictable. Payroll's still a bit of a wild card, but it's gotten better as well. So I think you can kind of plug in a more kind of normalized, give or take 3% type number. On rent growth, I think you're still a bit challenged, but depending on where you are and kind of also the short term versus the long term. And obviously, the story right now for multifamily is that long term expectation of a rebound. But also, you still have to temper that with the reality that a lot can happen in the macroeconomic environment. We know supply is going down, but a lot of other things can happen. And so you never want to get too optimistic. I talk to investors of all types, whether they're passive or some of the biggest in the country on the active side. It's almost like there's two things. Like there's one is like what do you underwrite, and number two is like what's your upside. And I think that's how I would think about it. Is I would still be like you typically are fairly conservative on kind of your base case scenario because you don't want to assume 5% rent growth and be dependent on that happening. But I also wouldn't be surprised. So if you're kind of on the fence, you may have that may be what pushes you over the edge to be involved with the deal. But I wouldn't assume it and be dependent on it, if that makes sense.
So balance the rosy scenario with the ideology that it may not happen at all and what happens if it doesn't.
Yeah, absolutely. I mean, again, you still have to be realistic, and I think that's it's not rocket science at all. But I would I'd be still very conservative in the short term. For the next especially the next year. I think for year two you can start to ramp it up, but again, just remember that there's the further you go out, the more uncertainties, the more that we don't know.
Yep. And that's why it's just a pro forma. It goes in the trash as soon as the deal's acquired, right? So,
Yeah.
all right, guys. Well, so we've talked about a lot. We've covered a lot of ground in a short period of time. Some questions that were difficult. I'm just going to make them harder from here on out. Okay. We're going to go into the speed round now. We're going to talk about 3 separate topics. I want to give you guys each about a minute to answer each because we've got about 15 minutes left. So we're going to have to move quickly here. I know we're not going to be able to address these at a granular level, but just high level. Okay. So we'll go to Greg first, and the first question is about the GSEs, the government sponsored entities. There's been a lot of talk that Fannie and Freddie would again become privatized. What implication does that have on capital markets and ultimately existing assets from operators who are either going to need to sell or refinance? Or, if you're thinking about new acquisitions, eventually, if this does happen, how does that impact financing rates, and should passive investors be keeping an eye on this?
I'll go right to that last question. Should we keep an eye on it? Absolutely. I mean, it could lead to big changes moving ahead, but this is such a complicated topic, and I think it's going to take a while to work out the plan if we even go in that direction. So what I'm really going to say is take a pass on this, and that there are things for you to worry about in terms of things that can go wrong or opportunities that may lie ahead that are going to hit you right in the face. And this is farther down the road, and worry about that when we cross this bridge.
Fair enough. Eric, what do you think?
Well, I'm of the same mindset. I think, look, in general, as investors, right, you worry about what you can control or what you can analyze. Look, the impact of privatizing Fannie and Freddie is sort of hard to imagine. I guess from my standpoint, look, there's no cheaper source of capital than the government, like it, love it or not. I mean, let's just face it. And so the question I really wonder about, and I'd look to my colleagues here, because I'm not sure even it's sort of a quasi-academic, is ultimately if they go private, however that ultimately looks and what they leave in terms of government ownership and the private sector, is what happens to that cost of capital. Because once you start, whatever the spreads are, if the extent that privatizing leads to higher base rates because just the risk becomes greater as not a government entity or sponsored entity, that's just something I'm keeping an eye out. But I again, it's hard to know exactly how this is going to shape up, as Greg alluded to. So I guess keep your eyes and ears peeled, and focus on what you can control and focus on.
I do think that Eric did hit the key point there, that anything you're going to do seems like you're going to increase general risk, which would suggest the cost of capital should be higher.
I'll take my first time to interject and disagree a little bit. I think I think it's going to be really hard for the government to ever get away from even an implied guarantee. And I think that the risk is being offset by reduced regulatory risk. We saw the prior administration and the prior presidential candidate had talked about nationalized rent control that could be done through Fannie and Freddie. That is a far greater risk than anything we all just discussed. That would completely change the that, I mean, I think that would actually undermine Freddie and Fannie's own missions as it relates to multifamily, in terms of creating a liquid market that keeps capital into the multifamily space. So, if it's privatized, the chances of a future administration enacting those types of provisions, I think, significantly go down. It takes the political risk out of the GSEs. So. I would again sort of it doesn't change the fact that what these guys said is true. It doesn't you don't think about Fannie and Freddie as what their future outlook is, how it impacts the current investment. All this stuff is very hypothetical. But again, I do think that offsets the other risks.
That's really interesting. I appreciate that context. And it's a good segue. I'm glad you mentioned rent control. Jay, let's stay with you. Is that how we solve the affordable housing crisis? Is to use rent control, or do we allow free market forces to prevail?
Well, I think it's for those of you who have been following the New York mayoral election, I think it's really fascinating that after 100 years of rent control, it's still not enough in New York City. It's still not enough. It's never enough. It's never good enough. There's always a new flavor. They've rewritten their rent control rules to recapture properties previously excluded. I believe at least 5 times. Now have new names like rent stabilization and good cause eviction and whatnot, and yet they still have the same problem to the point that it's like the centerpiece of the mayoral election in the nation's biggest city. And so, I mean, I could go on. I mean, there's plenty of evidence that this is obviously not the best way to solve the problem. We need to focus on what actually works, what the research shows works, not make it a political issue. And people like me talk about this, it's taken with a grain of salt because we're from the industry. You'll expect to hear that. But I mean, look at the academic research. I mean, there's ample research, and yet, we continue to sort of make up reasons to try to excuse what's already out there. So I think I think that it is what it is. I think that there's ample reason again to focus on the actual facts, but and the history of what actually works. And if we really care about trying to protect renters and affordability, we should do. I mean, we're in the era of trust the science. So trust what the science has shown us, the research has shown us, and that's really to build more housing. So I think that's become a bipartisan issue. The YIMBY focus of both progressives and libertarians are uniting around the cause of. We've seen big book written about this recently called Abundance. Supply is the solution, and we're seeing that happen in real time. If you're a renter in Austin, Texas, you may even gotten a renewal rent cut in these last few years. If you're living in New York, yeah, your rents are up some of the highest in the country. Same in Chicago. So I think the answer has been right in front of us for a long time.
I think this is a triggered topic because we're getting some chat action here. But Eric, I want to switch to you. If I'm a passive investor, why in the world would I want to invest in a market that has rent control? Is that what's going to help us here with affordability?
No, I know Jay teed it up so perfectly with the academic research side, because if I think about a topic about which I've written and spoken the most is probably rent control. And look, here's how I think about it macro, just from and it makes it a little wonkish, but we think about economic carrots and economic sticks. Rent control is an inclusionary zoning. Our economic sticks, they don't work. The evidence is overwhelming, and I always kind of joke that economists rarely agree. There's that old joke is, why should you cut off every economist's left hand so they can't say on the other hand, but the reality is this is one area where basically economists agree. Almost everyone, industry, academicians all agree. Rent control is a terrible policy. It doesn't work. And then people also go to the supply issue. And of course you go, okay, we'll just build it and they will come. It's Field of Dreams. But come on, New York City, Los Angeles, San Francisco, building, it rhymes with witch, okay? I mean, it's just dealing with all the impediments and challenges there. So it's not that easy. So I'm somebody, and again, my libertarians are not going to be happy with this, but I've always believed in economic carrots, incentives, whether it's again, I know it's government, don't get me wrong, but Section 8 housing, or you rent to, you do something on the rental side to help affordable tenants, you get some kind of property tax abatement or some other carrots, because I think that's where government makes the mistake. They're big on sticks because it's freaking easy. It's the lazy policy way to go. And one last thing, and I'll shut the heck up, is if you think this is a blue state issue alone, you're wrong. It is across the country. There was some city council meeting in Kansas City in Missouri interrupted by, the rent's too damn high, the rent's too damn high. And that, so don't kid yourself. It's a broader problem than that. And my fear is that rent control becomes the policy lever because it's easy and it's just going to exacerbate the problem.
Greg, let's get you in the ring on this one. What do you think?
I agree with everything that has been said here, and Eric is right. I mean, this is one of the few topics where virtually every economist is going to come up on the same side on what's the policy moving ahead. I will say that I feel like we've made some progress in the messaging of build more housing, and some of the places that have really had obstacles to further building are trying to tear down those obstacles. I don't think in those spots we'll ever deliver enough product to solve the problem, but I do think we are making some progress there.
Good to hear. All right, last topic. Something that I'm kind of watching, and I guess I'm cautiously optimistic, but also a little concerned, is the trend to allow 401k participation to invest into alternative assets. And coupled with that is the emergence of cryptocurrency in the form of tokenizing real estate. To me, this leads to, in both cases, more capital flow into the space, probably more ignorance from investors who don't know what they're investing in, and the potential to lose big. That creates its own set of issues as to who comes in as general partners. But I also think it makes the market, in a sense, more efficient because the access is there, lower minimum investments, etc. Are these good things for the space? How does it show up from a risk-adjusted return basis moving forward? Eric, let's start with you.
I have no idea. I mean, Paul, it's I guess I should be candid. You ask a faculty member a question, there's no question we can't answer. I mean, it's just how much I want to.
That's why I asked you first.
As long as I know more than the audience, it's fine. But this is one, Paul, honestly, I heard sort of, tokenization and the impact of crypto. And I did a podcast episode on crypto, and I guess I've been proven wrong. Because of course I was, not surprisingly, far more cynical, on this whole crypto, movement generally. I mean, in theory, of course, anything you can do to increase liquidity, as you said, Paul, reduce impediments and all that seem to be, improve capital flows, all make sense. But it comes at cost. There's still going to be regulatory question marks, and I would just say this: when you start having that kind of sort of change, my concern is the F word, and that's fraud. Okay, that you're going to have a lot of sort of improper, whether it's sponsors, people taking from unsophisticated investors, and we sort of let regulations go. And again, there's always that balancing act. What happens? And I really don't know how it plays out, but I've been hearing about it for years, and so maybe it's just going to be one of those things that sort of bleeds in very slowly and may never happen. I don't know, but I do worry about, look, the balance between regulation and free markets and all that is a very tricky thing. And talk about tokenization and crypto, I get a little nervous, but I'll leave it at that.
Understood. Greg, what do you think?
I'll leave it at that. That one is so far outside my area of expertise that I don't know that I can add any insight at all on that question.
Okay, fair enough. We're getting close to the top of the hour, so that's just fine. Jay, do you have anything else to add?
No, very little. I mean, I think more liquidity is always good, but obviously we need proper safeguards around it. But certainly, I would rely on a financial expert, personal finance expert, more than one of us guys on this topic.
I think we've learned that the panelists here do not actually own a significant block of Bitcoin.
Never owned it. It's funny, just you'd be curious. I know we're getting to the top there. I asked my class, how many of my students, because they're all in their 20s or early 30s, and almost all of them have bought crypto. And then I asked them the next question is, how many of you actually transacted in crypto? Nobody, which I think speaks volume as to what it really is, but I'll leave that for maybe our next hour.
I hope there is a next one, but we are out of time today. Greg, Eric, and Jay, thank you guys so much for being here and sharing your insights. I hope it was a valuable hour for the community that was here, the members that joined us, and we thank you guys for tuning in during your lunch hour, or if you're out on the West Coast, early in the morning. So until next time, thank you from Passive Pockets, and we appreciate you guys very much.
Thanks, guys.
Oh, let's see, get out of here.